Good morning, everybody. I think there's still a few people just sort of coming in at the moment. Can we just quickly go in the chat? I just want to make sure everybody can just see the first slide there, sort of introductory slide. If you can just maybe give me a little bit of an indication, that'd be absolutely fantastic. But welcome to today's webinar and the Know Your Numbers. This is presented in conjunction with the Chichester Chamber of Commerce and Industry. My name is Andre, and I am the practice manager here at Rowdens, and I'll be your moderator for today. Just very quickly, for those of you who are unfamiliar with the webinar environment, these are the Zoom settings, and let's just take a little closer look at the webinar controls. At the bottom there, you have audio settings. This is where you can select and test your speakers. We also are going to use the Q&A button today, and that's where you can submit any questions that you have, and we will answer those a little bit later on today. And then if for any reason you need to leave the meeting or the webinar, just click on the Leave Meeting button that we have there. Now, to move on to our presentation, I would like to introduce to you our presenter, Penny Rowden. Jonathan is also on the meeting, and he'll be available later on to answer any questions if there's any. And then welcome, Penny Rowden.
Lovely. Thanks very much, Andre, and thank you to everyone for joining us today. First of all, I just wanted to show a quick slide on Rowdens Chartered Accountants and who we are, for those of you who aren't clients of ours. We're fundamentally a firm of chartered accountants based on the south coast here in Chichester, and we specialise in family-owned businesses. So businesses where that is really creates the lifestyle for the owners. Our core purpose, or our mantra, is achieving success together. So your success is our success, and our core values are listed here. And fundamentally, we've chosen them because they're what makes us us, really, and what we care about when we're dealing with our clients. As many of you know, we are very techie accountants. We're very on the cloud, and we care a lot about using technology to be as efficient as possible. So that's why we've got innovative in there. It's about not accepting the status quo and looking for opportunities and always mapping out a plan for change. So we're always looking for the best way we can achieve things. We want to inspire our clients, and we want to work with them to help their dreams come true, whatever that is, whether that's having more time with the family, making lots of money, having successful businesses, whatever it is. We all want to have fun along the way. And so we do have a good laugh in the office, hopefully not at our clients' expense, but trying to enjoy what we do. Clear communication is very important to us. We try not to use what we call accountanese too much, so that clients can understand what we're saying. And that's one of the reasons for doing the webinar today, to try and demystify the accounts and the reports that one gets out of one software and bookkeeping. And then the other thing we really care about is nurturing. And we've chosen that word really carefully. It's not just about care, although obviously that's very important to us, but it's about helping our clients grow, but sometimes being firm as well. It's not just about giving clients everything they want when they want it. We want to do that as much as possible, but we also want them to help to grow successful businesses. Right, let's get into the webinar proper now. So before I start, I thought I'd share a thought for the session. The budget is not just a collection of numbers, but an expression of our values and aspirations. Hopefully you've all updated your budgets and forecasts to reflect the challenges of the COVID-19 situation. These numbers express your aspirations for the business over the next 12 months. Now it's time to make sure you can understand, monitor, and measure what you set in those budgets and forecasts. This webinar is about demystifying the most common reports you'll be seeing on a weekly, monthly, quarterly, and annual basis, so that you're in control of your business performance. Next, we'll go through the agenda for the session. Over the next 60 minutes, we'll cover the importance of knowing your numbers, an overview of the different reports you should be producing, the difference between profit and cash, the key drivers of business value, how to protect your assets, and how to adopt best practice. We'll then outline some potential next steps for you to take to make sure you truly understand your numbers. Please make sure you take plenty of notes today. Some of what we talk about might sound like a foreign language to you. That's what I've already mentioned, what we like to call a Cantonese. So send through your questions at any time during the webinar for us to answer near the end. So why you need to know your numbers. Knowing your numbers is vital as it allows you to interpret your reports and know if you're on track to achieve the goals set in your business plan or business recovery plan. Here are my top 6 reasons why you need to know your numbers. First of all, they tell the story of your business, allowing you to interpret the results of your business activity. This helps you identify the symptoms versus the root causes. For example, a decline in gross profit is a symptom of many root causes, such as ineffective pricing, rework, poor purchasing, or wastage. Knowing your numbers will enable you to spot an early warning sign of a potential issue. For example, monitoring how long it takes customers to pay you allows you to quickly respond if that number starts to increase. Areas of strength and weakness will be highlighted. For example, your balance sheet indicates whether your business value is going up or down. Understanding your numbers also means you have reliable financial information to base your decisions on. And finally, knowledge is power. The more you know about your business, the better your business will be. Now we're going to go to an overview of the key reports. We'll be reviewing each of these key reports to help you understand what you can learn from them. We'll work through an example to show key learnings and things to look out for in your reports. We'll use the same fictitious company, Foodsco, for the example. And there on the screen, you've got an overview of the key reports. So first of all, we're going to look at the trading account. This tracks your sales, variable costs, and gross profit to calculate the return you're achieving before deducting your fixed overhead costs. Your gross profit percentage indicates whether your margins are improving or deteriorating. You can track your results across different divisions or product lines by using multiple trading accounts. For example, if you have regional locations, having a trading account for each location allows you to track how each is performing. And we can do that in Xero by using tracking categories. So if anybody here is using Xero, then talk to us about how you can do that. Small adjustments to the items in your trading account can have a huge impact on your overall results, which I'll demonstrate now. This is an example of a food manufacturing company's trading account. As you can see, they had sales of just over 1 million, cost of sales of 318,000 odd. Their direct costs were over 450,000. So their gross surplus was 248,749, giving a gross profit percentage of 24%. Let's say this company undertakes coaching with their accountant and implements strategies to increase their customer retention rate, resulting in a 10% increase in sales. They also work with their accountant to review their stock processes and reduce their cost of sales by 5%. They renegotiate their contract with their delivery provider, resulting in a 5% saving in their direct costs. As a result of these changes, their gross surplus has increased by 140,251, and their gross profit percentage has increased from 24% to 35%. Understanding your trading account allows you to identify areas where small improvements can have a big impact on the profitability of your business. Next, we're going to have a look at the profit and loss account. So this is also known as an income statement, and it shows all of your earnings and costs over the year and tracks the overall performance of your business. It matches your income and expenses for the period with adjustments made for timing differences. For example, sales that have been made, but work hasn't yet been done. It's important to remember that profit is not the same as cash. The profit shown in your profit and loss account includes non-cash expenses such as depreciation. You must ensure you have sufficient profit to cover cash costs such as loan principal repayments, asset purchases, and drawings. Your profit and loss account provides a framework to benchmark your results by using percentages or comparisons between years to compare your business performance to similar businesses. Businesses are generally valued using a multiplier of earnings, so your profit and loss account is a fundamental driver of the value of your business. The higher your earnings, the higher your value. This is an example of a profit and loss account using the same fictitious food manufacturing company. We've taken the gross profit from the trading account and listed all of the expenses to calculate the net profit or loss. Often the trading account is the first section you see on an overall profit and loss account, but we've separated it here to focus on the relevant sections. As you can see, the company is currently trading at a loss of over 113,000. Let's say the company undertakes a review of all their expenses with their accountant and identifies potential savings to be made to their insurances and rent. They contact an insurance broker and their landlord and negotiate a 5% reduction for both expenses. They've saved £597 in insurance expenses and just under £3,000 in rent expenses. However, you'll notice that accountancy fees have gone up. Remember, in the previous example, the company had engaged their accountant for coaching and other services. But despite the increase in the accountancy fees, the overall net surplus has increased by 138,000 to 24,000 due to the savings made. So now we're on to the balance sheet. Your balance sheet, also known as a statement of financial position, provides a snapshot of your business's financial position at a specific point in time. It measures the net worth of your business, which is your assets less your liabilities. It also shows if your business is solvent. If your liabilities are greater than your assets, then the business is insolvent and urgent action is needed to fix this. You can compare different periods to determine whether the business's net worth is increasing or decreasing between years and can track the strength of the business. The stronger your balance sheet, the easier it will be for your business to survive a downturn. It also provides a basis to calculate key ratios, such as debtor days and inventory days. Inventory is just another word for stock, i.e. goods you're holding for resale, or work in progress, which is work you've done for a customer but not yet invoiced. As you can see, the company is currently insolvent as it has more liabilities than assets. Its working capital is also negative as its current assets of 138,475 are less than current liabilities of 162,269. This means the company cannot pay its short-term debts from the limited cash, debtors and stock it has on hand. Urgent action is required to remedy this. The business needs an injection of funds of at least 305,000, which may be in the form of share capital or a shareholder loan, or a director loan, I suppose, for that matter. Assuming the company can resolve these urgent solvency issues, there are other areas for improvement too. Over the long term, the company could implement strategies to reduce their debtor days and inventory days to increase their cash flow. To calculate your debtor days, divide debtors by sales, then multiply by 365. This tells you how long it takes customers to pay. Currently, this company's debtor days are 26. This means that on average, it takes customers 26 days to pay their bills. If they updated their terms of trade and requested payment within 7 days and managed to reduce this by 5 days to 21 days, they'd have an additional £13,944 available. To calculate inventory days, divide inventories by cost of sales, then multiply by 365. This tells you how long the business holds its inventory before selling it. In other words, it shows how long your cash is tied up in inventory. This company currently holds inventory for 74 days. If they reviewed and updated their inventory processes and reduced the amount of inventory they have on hand, they might be able to improve their inventory days by 9 days. This would result in a cash flow boost of £7,860. So while this cash flow gain of nearly 22,000 doesn't fix the solvency issue, it demonstrates how much cash could be saved with some help from their accountant. So next we come to the statement of changes in equity. This shows what happens to the profits. They could be paid out as dividends or kept in the business as retained earnings. It represents the net worth or value of the company and is a key indicator of the company's financial health. It shows whether a company is solvent. Remember, if the company has more liabilities than assets, it's insolvent, and funds will need to be paid into the company. The company has accumulated losses for at least the last 3 years. This means the company has no retained earnings and is currently insolvent. There's no money to pay out as dividends and no money to reinvest into the company to purchase new assets. The directors must take action now to increase the profitability of the company. The director's current account records all funds introduced to the business by directors or taken out of the business as drawings. It can help you monitor your personal expenditure from the business. And for businesses with more than one director, it maintains a balance of the amount each director has introduced or withdrawn from the business. It shows how much the business owes to each director. If the account is overdrawn, it means the director has taken out more than they've put in and now owes the company money. To put the account back into a positive balance, the director can repay the loan, or the company can increase its profit, pay a director's salary, or a dividend can be declared. If your direct current account is overdrawn, it's important to get advice from your accountant as soon as possible to discuss the best options for you and your business. It should be noted that HMRC do demand a payment on account of corporation tax on an overdrawn loan account. So it is very important that you do keep that in a current position. The director current account in this example shows that at the start of the period, the company owed its sole director, Mr. Doe, over £29,000. He has introduced £2,000 into the company during the year, but has taken over £9,000 out of the company in drawings and personal expenses. This means that at the end of the period, the company now owes Mr. Doe just under £22,000. The amount owed by the company to Mr. Doe can only be repaid if the company is solvent and has the cash available to make the repayment. Because our example company is insolvent, Mr. Doe will need to introduce yet more funds into the company so it's not trading while insolvent. To ensure the company will be able to repay the funds introduced, a profit improvement strategy should be implemented so the company becomes profitable. For example, we demonstrated in the trading account and profit and loss account examples how small changes to processes could result in an improvement of 138,000. It's not sustainable for the directors to keep introducing money into the business if it's not profitable. The fixed asset register, also known as a depreciation schedule, records a business's fixed assets, such as vehicles and plant and equipment, and computer equipment, office equipment, etc., and facilitates the spread of the cost of the assets over their useful life. It provides a basis for keeping track of a business's assets and can be a useful guide to determine when assets need to be replaced, so they can be budgeted for accordingly. It's also useful when selling a business, as it records the current value of all fixed assets. The first column of the fixed asset register lists the names of all the fixed assets, with the second column listing the cost of the asset on the purchase date. The next column shows the opening value of the asset at the start of the financial year. This is the cost less the closing accumulated depreciation from the previous period, and we call it the net book value. The next two columns show any purchases of new assets or disposals of old assets. A disposal could simply mean that the asset has reached the end of its useful life to depreciation purposes and no longer holds any accounting value. So we can write it off via a disposal. Then we have the depreciation rate and method of depreciation used. This company uses the reducing balance method, which depreciates each asset by a constant percentage each year based on their net book value. The next column shows the depreciation for the period, followed by the closing accumulated depreciation. This is the amount the asset has been depreciated by since it was purchased. And finally, the closing net book value column shows the closing net book value of the asset. This is the value that will be recorded in the balance sheet. So that sums up 6 of the key reports you should be producing and reviewing regularly. Each report tells a different story about your business and aids your decision-making in a different way. If you have any questions about any of the reports, send them through now and we'll answer them shortly. In the meantime, we'll move on to understanding the difference between profit and cash. It's common for business owners to get frustrated that their bank account doesn't seem to reflect their profits. It's essential that you understand the difference between profit and cash and why a high profit doesn't necessarily result in more cash in your bank account. A profitable business can go out of business because it's starved of cash. A business running at a loss can survive because it has access to funds from investors or financiers. In other words, cash flow is every business's reality. And there are sort of countless cases of businesses who are trying to improve by just increasing sales. But if they don't control their debtors and the time that those debtors take to pay them on those sales, they can easily go bust because they run out of cash. So it really is absolutely crucial to be able to understand the difference. To demonstrate the difference between profit and cash, consider these items. VAT affects your cash balance, but not your profit. So that will go under the cash column. Loan repayments. These affect your cash balance, but not your profit. So again, under the cash column. But interest on loans, these affect both your profit and your cash balance. So they go under both. Asset purchases, they only affect your cash balance. Asset sales, again, they only affect your cash balance. But depreciation, that only affects your profit. As you can see, even if your business achieved a healthy profit, there may not be any cash in the bank after paying tax, making loan repayments, and buying new assets, because these all affect cash. The Business 101 cycle is another useful way to demonstrate the difference between profit and cash. First, the owners need to invest money in the business. This money can then be used to purchase the assets needed to run the business. The business may need additional funding to buy all the assets they need, so they may take a loan to finance the purchases. These assets are then used to generate a profit. You can increase your profit by growing your sales or margins, but overhead expenses can drain your profit and result in a loss if they're not managed. The profit then gets turned into cash. Drains on your cash include slow collection of debtors, high inventory days, loan repayments, tax repayments, and payments to suppliers. The business can achieve cash gains by collecting their debtors faster, decreasing their inventory days, negotiating longer payment terms with suppliers, and reducing tax. The owners then take cash out of the business as drawings or personal loan repayments. The remaining cash can then be reinvested into the business to purchase more assets to generate more income. The aim is to go through the cycle as quickly as possible to increase your return on investment, i.e. ROI. After cash flow, business value is the next most important measure of business success. Part of knowing your numbers is understanding and measuring the drivers of your business value. These drivers might be your monthly recurring revenue, revenue growth, revenue per client, sales or profit. These will be different for every business, but we can work with you to identify the drivers of your business value. To enhance the value of your business, you must first develop and implement a clear plan and document your organisation structure and roles within your business. Establishing cloud-based real-time reporting allows you to make better decisions, and reviewing and documenting your systems and processes ensures your business is running as efficiently as possible. Reducing the reliance on the owners of the business helps enhance the value, as it will be easier for new owners to take over when the business is sold. And finally, identifying and managing risks means these can be mitigated before they become an issue. As we've seen throughout the webinar, the profitability, cash flow, and value of your business all affect you personally. If your business isn't profitable and doesn't have much cash available, you won't be able to pay yourself to fund your desired lifestyle. There are a few other things you can do to help protect your assets, which I'll quickly run through now. Set up your business as a company to limit your personal liability. Consider who should be a director of your company and which assets are held personally by directors. That'll be things like whether to have a company car or whether to run your own car and then the company pay business mileage. Ensure that you have security over any money you lend to others. Consider alternative ownership structures for high value assets. For example, if your business owns the commercial premises you use, consider moving the ownership of the premises to a separate limited liability company, or it could be a pension fund as well. Review your terms of trade and credit policies to ensure you only provide credit to customers who are likely to pay you. Review your insurances and make sure you have sufficient protection. For example, do you have business interruption insurance, indemnity insurance, and enough cover to ensure the impact on your business of any adverse events is as minimal as possible? Ensure you undertake financial planning to manage your personal wealth outside of the business. And finally, plan for the future. Do you have an up-to-date will, powers of attorney, and a clear plan for transferring your assets to the next generation? This isn't an exhaustive list. They're just some of the ways you can protect both your business assets and personal assets. We can help you identify specific ways you can protect your assets. How does everything I've talked about today come together as best practice? Every business should use the 3 essential tools. First, an annual business plan, or in these times, a business recovery plan might be a better option. An annual forecast. Ongoing reporting and accountability. The reporting ensures the numbers you want to achieve in your plan and forecast are being measured. The accountability process is some form of coaching. Using an independent coach to hold you accountable works. Knowing your numbers is just the beginning, as it allows you to improve them and ultimately achieve your goals for the business. So where to from here in these challenging times? My aim is to help you take what you've learned today and implement some positive changes in your business. Now is the time for you to decide what you're going to do. Take a few minutes after the webinar to write down 3 actions or projects that will add value to your business. What problems are you experiencing in your business? Identify these problems and use them as an opportunity to create a project to fix them. Doing nothing right now should not be an option. So now you know what you should be doing as best practice in your business. Here's how we can help you. If you don't currently have a business plan or business recovery plan, we can help you develop one. We can also create an updated cash flow forecast, which reflects the ongoing impact of COVID-19, if that's relevant to you. For those who need to be held accountable to complete your actions, we have a range of coaching options depending on the frequency which suits you. We can create your management reports each month, catching up with you to review them so we can discuss potential areas for improvement. We can also do those quarterly as well, which often works to sort of tie in with your VAT return. And finally, we offer a complimentary 1-hour meeting for both clients and people who aren't clients. to have a look at where you're at and to discuss future progress, really. So, and also how we can help you, obviously. So we know it may be difficult to commit to spending money right now. All of these services include an assessment as to how you can improve your profitability and cash flow. So there will be a great return on investment from this process over time. For the short term, we have different payment options available, so please don't let cost be a barrier. Get in touch and we can work together to come to an arrangement you can manage. We know that the benefits you'll get from these services will be far greater than our fee. Most importantly, it's about helping you as quickly as possible and ensuring we're working with you to build a stronger, more resilient business. The information in this educational webinar is general in nature and no substitute for specific tailored advice and support. By working with you one-on-one, we'll be able to identify the most important actions to take that will make the biggest impact on your results. So I'm going to hand back to Andre and we can answer any questions. Looks like we've absolutely romped through that webinar, as it's just about 10:05. So please do pass your questions. We've got now plenty of time to answer them. And it's a good chance to find out more from Jonathan and me about profit versus cash and what these reports actually mean.
Thank you very much, Penny. Just very clear, I've got a few questions which has popped in here. The first one that we have here is, what is the difference between the annual accounts and accounts that are produced throughout the year?
Good one. The annual accounts contain year-end adjustments for things like depreciation, tax, splitting interest and principal on loans, prepayments and other accountanese type jargon. They're the statutory accounts, they're the things that we submit to HMRC and Companies House if you have a limited company. But the main difference really is that the annual accounts are historical, so they're based up to your accounting year end, and whereas your regular management accounts give you up-to-date data. So in many ways, actually, to run a business, the management accounts are far more than the annual accounts. And I think because the compliance regime has got very tight over the last, 20, 30 years or whatever, we've all got very sort of hooked into doing year-end accounts to satisfy the tax man and Companies House. But actually what businesses should be really looking at is their figures on a regular basis, and obviously management accounts really helps that. So for us, really, the management accounts are far more important. And then the annual accounts should just really pop out at the year end just to satisfy the statutory liabilities. I don't know, Jonathan, if you've got any thing to add on to that at all. Oh.
So I was busy trying to find my unmute button. Yeah. I think, especially with online cloud accounting software and clients getting more involved in their numbers, the current profit and loss account is far more useful than sitting down with clients or 6 or 7 months after the year end saying, hi, here are your results for the year, because clients don't really have any interest in that. Typically they say, well, what's my tax bill? Then it's quickly followed by, but I can't have made that much profit, I don't have any money. And Penny's been talking about the difference between profit and cash, and that's where you have to sit down and go through them and explain how they've used the cash the business has generated. So I think year-end accounts, you just have to do them because the law says you have to have them. Management accounts, I think that's just essential for business.
I think that's absolutely fantastic, Jonathan and Penny. I think that's lovely. I had another question sort of pop in. The saying, basically, the majority of the presentation was focused on a business in trouble. What are the key differences in the reporting to keep on top of basically the figures for a growing or successful business? And I think we've touched on a few points basically there for it. But Penny, if you'd like to just sort of take over for that.
Yeah, I think you're absolutely right. We were sort of focusing on sort of an overdrawn balance sheet, etc. And for growing businesses, it's really key to keep control of cash. That's the most important thing, because unless you're, but particularly if you have debtors, I mean, if you're an online or retail business, then cash, people tend to pay sort of on the nail, so that's a different scenario. But for businesses where you have customers that pay you, typically 30 days, 60 days or whatever after the invoice is raised, then keeping really tight control of your of the credit you give, and in this day and age as well, particularly doing credit checks on new customers as well is very important. There are various things that you can do to help that. I mean, Xero has its own invoice chasing system that's free within Xero, so it's called invoice reminders, so that can be turned on, so that just sends out an email to your customers to remind them to pay you, because or you can use Stripe as a credit card payment facility, or we use Go Cardless, which works brilliantly with Xero and collects the amount due on the invoice on the due day. So that's really good for repeating customers where they've got regular invoices with you. That's one big thing. Jonathan, let you add on that one more. Jonathan, sorry, if you turned your webcam.
What I was saying is one of the saddest things we're going to see is businesses that overtrade in the next few months because they've been running on empty. They've not had any business. All of a sudden, taps are turned on because people are coming out of lockdown and their business is booming. So they're busy selling, think absolutely great, we've made it, and then they run out of cash, and that's the sad part. There are things they can do, but if they've sucked their cash reserves down because they've had no business for a year, their opportunities are quite slim. So if anyone's getting really excited about trading, that's good news, but just be careful not to overtrade. Manage your cash flow.
Fantastic. I think there's getting back to the cash flow. For a follow-up question before that as well. Keeping control basically of the cash flow there. It's where the costs, basically the direct cost basically has been controlled really well, but it's growing a little bit faster than the sales rate. So I guess basically that is now obviously a cash flow, a key indicator basically for a cash flow problem in the brewing at the moment.
Yeah, that's right. Absolutely.
Is that sort of just typically something we would like people just to give us a call? We can have a look at things for them and have a little bit of a chat through that and see what possible answers we can go and give them for that. Yeah, absolutely. I mean, that's why we have a sort of complimentary meeting, so that we can sit down and sort of review your figures with you, and we call it a client complimentary review, but we can do it for non-clients as well, and sort of sit down, discuss the figures, and really sort of start to put a plan in action to be able to look at where you're going, what your plans are. So where having a business plan really helps, because you can look ahead and set your goals, your personal goals and your business goals, and work out exactly what you're going to do. And then that gives you a blueprint to work towards. We like to do a business plan with quarterly coaching effectively, because that then helps people to keep on track. We can then look at your numbers in Xero, or whatever accounting system you're using. For most of our clients, it's Xero, and then help you keep on track and tweak your budgets if necessary, and so on and so forth. So it really enables you to keep a very close eye on what you're doing. One of the management reports that we use, we've developed a management reporting system called RVibe, which helps you keep track of those numbers and produces some really nice key performance indicators as well, called KPIs, that you can look at, so you can see how you're doing month on month, quarter on quarter, year on year. But also we'll give you some really nice graphical representations of the figures in Xero as well, so that you can keep an eye on what's happening. If you're over reliant on
2 or 3 customers or clients, for instance, which can be quite a danger signal, because obviously if they go bust, then you can lose a massive amount of your sales in one go. So it's just really looking at your figures and understanding them and interpreting them, which is just so key to what you do. And I think an awful lot of businesses do just tend to fly by the seat of their pants, and just as long as they've got some money in the bank or they're keeping their overdraft under control, that's all they're looking at, but they're actually not foreseeing what's coming down the future. So for instance, like, you know, if you are profitable, you're going to have a corporation tax bill to pay 9 months after your year end. So you really should be providing for that. If you're VAT registered, then your VAT will be due each quarter. And one of the things the government has done is, of course, allowed certain tax payments to be deferred. And that's great when you're in the sort of difficulties that we've had over the pandemic, but it's equally important that, you know, the money does, the chickens do come to roost at some point. So you do have to have a plan on how you are going to repay that. And also how you deal with disasters. You know, we mentioned insurance and things, and you know, we've had a client a couple of years ago that their software failed, and it turned out that their backups, which they were doing everything correctly, but unfortunately the company who was doing their backup wasn't able to retrieve the backup of their data. So that caused them, you know, a great deal of stress. We managed to get around it, but by doing other things. But you know, he could have had a client who's just had a fire, so you know, which destroyed a lot of paper records. So it proves how important it is to keep things on the cloud or in different places and make sure you've got proper security. So all these things are very important.
That's fantastic.
We can help you with.
No, thank you very much, Penny. I think, Jonathan, I've got another question that has just popped up here. If you can maybe just unmute yourself there very quickly. We have a question here that says, basically, in your experience, what is the average number of days that a debtor pays? Does it vary basically from industry to industry?
Yeah, absolutely. And I think it also depends on how you have structured your own business. I mean, clearly, if you're an online seller, people typically pay with credit card. Job's done. So it's not as long as it takes to get the money from Stripe or Go Cardless or PayPal. If you're dealing with large corporates like Tesco's, they may say, you know, 90 days to 120 days. And if you're dealing with business with those sort of people, you need to factor that time in. We're trying to encourage clients perhaps to use Go Cardless wherever possible. So we're using it in Rowdens, and it's effectively it's a direct debit mandate. So small firms generally can't get a direct debit set up, authority to do direct debits through their bank if they're small. So Go Cardless sits as an intermediary. So that helps speed up the cash flow, because you will be paid on the day you're supposed to be paid. If there's funds in your customer's bank accounts, that will help you speed up the return on the money. Obviously, if you've got a couple of heavies that you can send round, threatening dire circumstances and results if clients don't pay, I wouldn't recommend it, but I'm sure that some people are very tempted. I saw in today's paper that a builder had demolished a house he built because the client didn't want to pay all the bill in full. I mean, that's totally outrageous, but that's one way of getting your money in quickly.
That's fantastic. No, thank you very much, Jonathan. Just Penny, I think basically here's one that sort of popped up, I think that you could help with as well. What is the difference between a markup and a margin? You spoke a little bit earlier about gross margin. Is this the same as a markup or not?
Yes, no. The markup in pound terms is the same as the margin, in that both are the difference between the cost price and the selling price. But in terms of percentages, markup and margin are not the same. So for example, if you buy stock for £75 and you sell it for 100 quid, your markup is 33%, which is 100 divided by 75. But the margin is 25%. And that's the £25 profit divided into the sale price of 100 quid. So they are different. It just sort of depends on the maths and what you're looking at. So yeah, no, they're not quite the same.
No, it's fantastic. No, thank you very much. And I've just got, I think, another question I think we want to go cover before we sort of wrap up there. You mentioned a little bit earlier about an overdrawn director's loan account. What is the implications of that with HMRC? I mean, maybe if Jonathan wants to jump in as well.
Yeah, Jonathan, you do that one.
Thank you for that hospital pass, Andre. Okay, so the basic rule is that if you have an overdrawn director's loan account at the end of your accounting period, so if you owe the company, let's say £10,000, if you don't repay that loan within 9 months of the year end, the revenue would expect the company to lend, and please note it's the word lend, 32.5% of that loan. So it's quite penal. Why 32.5%? If you go back a few years, it was a cunning wheeze us accountants came up with to say to clients, look, tax rates are 80%, 90%, don't take money out as a dividend, borrow the money from the company. The revenue got wind of this and thought, well, we're missing out on our revenue. So they brought in various charges and ways of doing it, and currently it's 32.5%, which is effectively the rate a higher rate taxpayer will pay on the dividends. That's why it's 32.5%, and it's designed to be quite penal. And I think that's one of the biggest things we see, or we're going to see going forward, with clients who've not had a good year trading wise. Cash flow has been appalling, and I get it that they're going to take money out of the company to survive, but there is going to be a process they're going to have to go through to repay that loan, or lend the revenue the money. And I think I'm currently writing a blog from the dog, with Lyra going on a diet, because I tend to use the example of biscuits with her in terms of profit, and she's eaten all the profits and no money for the tax man. So she's going on a diet next year. So look out for that if you want to see the sort of the practical implications of how you're going to have to sort your loan account out.
Jonathan, do you just want to quickly add, just while we're still here, we've just got a few minutes, just about the sort of kind of why we do dividend and salary, because that again I think can be quite confusing for people.
Sorry, what's the question again?
Sorry, why for limited companies we tend to recommend a low salary and then take the balance out as dividends?
Okay, so the answer to that question is it is more efficient in cash flow terms to go down that route, and it's not really tax, it's more national insurance. And this is sometimes when I sort of sit down with a piece of paper and a diagram for clients, which sadly I can't show you, but if we went around the room and asked people what their director's salary is, it's probably sort of £700-800 a month, and that's pitched so that you don't actually pay any employees national insurance, but you do get a year's tick towards your state pension, because effectively there's a band that revenue say, yes, you are paying national insurance, but you're paying at 0%. I mean, only the revenue can have something that says, yes, you're paying national insurance at 0%, but that's what they say. So ultimately, when we say it's a tax saving, it's really a national insurance saving. And it's the savings being squeezed a little bit because they've now introduced this 7.5% tax on dividends. But if you're making £30,000-40,000 profit per person in the business, so if you're a sole trader or sole limited company, if you're making £30,000-40,000, it's quite tax effective to be a limited company. Plus you have protection of your personal assets in case the business goes bust. So it's, and whether that tax saving will carry on, I don't know, because clearly the government are on the attack. They want more money. So my money is a bit on, perhaps that 7.5% on dividends will go up to 10%, which will narrow the tax saving further. Does that answer the question?
Yeah, that's good. I just think it's always a useful one to help people understand why we recommend this. Okay, great.
That's fantastic.
So,
I've just got one other question which has just popped up here. It's regarding the Go Cardless payments, where basically expenses are being paid through Go Cardless. It is not showing up. It doesn't identify the supplier on that. Now, I assume that refers to on the bank feeds in Xero, that it doesn't identify basically on there. And so this person basically has to go back to Go Cardless and go and say, find the payment to see the way that which supplier it was. Is there a way that suppliers can show themselves on a Go Cardless payment?
There is, they have to pay for it. Interestingly, it does seem a bit random, because I think with our ones, it does show as Rowdens, even, you know, whether that's because we've done it through Go Cardless for Zero, I don't know. But I noticed it sort of comes up as Go Cardless and then it has Rowdens underneath. But it is a problem, and certainly it's, you know, to get that you have to pay about £50 a month or something, so suppliers tend not to, thinking, I guess thinking they're the only ones that are going to be you know, going to be charging their clients by Go Cardless, so of course clients should know. But I agree, I find it really annoying when I'm going through a bank feed and all I've got is Go Cardless, and then trying to find actually who it relates to can be a bit of a problem. Certainly from our point of view, obviously we get an email from Go Cardless which tells us which clients are paid, and then we also have a Go Cardless sort of dummy account in Xero which also tells us who's sort of kind of direct debits are making up the payment. But I certainly agree from the customer's point of view, it's or the client's point of view, it's not so good. But that's the reason why the Go Cardless are trying to make people pay. I think it's well worth making the point again to Go Cardless. So I think that's something that I'll certainly raise with them again and just say it really is a very, very irritating, and you know, it's just an extra way of them trying to get money from people who use it.
So fantastic. So basically, just confirm, basically my understanding of that is the way that Go Cardless is sending information basically to the bank itself.
Yes,
and basically with the bank feeds then coming into Xero, it doesn't show the detail.
That's right. Well, not in some cases it does, because
okay.
Certainly we have one supplier, our IT supplier. You know, his comes through, and we pay him by Go Cardless, and it comes through with his company name, and he tells me he's not paying extra. I certainly notice it does on ours, and we're not paying extra. But most people, but I don't know if it's because they're not using Go Cardless for Xero, and whether that makes a difference. Just a quick warning on that one though, we are having some issues because Xero have changed their Go Cardless integration, and so for new people joining trying to set up Go Cardless for Xero, it is causing some issues at the moment, so it might be worth waiting till they've sort of kind of finalised their integration before you start using it. But if not, have a chat with us and we'll see if we can help.
Yeah, that is fantastic. No, thank you very much, ma'am. Thank you, Jonathan, as well. Okay,
so we've got just one more slide really, which is just a thank you slide, and just to say that we've you know, so our next webinar is about reclaiming your time, and that will be on Wednesday the 14th of July at 9:30 again. And please do complete the brief exit survey that will hopefully pop up following this session, because we'd like to obviously continuously improve and get your feedback on what other webinar topics you'd like to see from us. And we hope we've given you plenty of ideas to ponder and some clear next steps for you and your business. So thank you very much for attending the webinar and taking the time to be with us this morning. So thanks very much. Okay.
Thank you. Thank you very much, everybody.
Bye, everyone.